Deputy Owen Murphy, 6 minutes.
Just to come back to your recipe that you were outlining to us earlier on, and the second step in that recipe is the making of bad or terrible loans. What's the motivation behind the making of those loans?
Because that is what, so again, wonderful question. So let's look at the counterfactual. What if you tried to grow very, very rapidly and charged a premium nominal interest rate by making good loans in a relatively competitive industry like banking with a mature product? In other words, this is not the invention of the iPad the first time, where you could sell it to billions of people. If you wanted to grow 50% a year by making really good loans, what would you have to do?
I don't know.
You'd have to buy market share. You'd have to reduce your interest rate to be able to get really good borrowers in their business, right? Because good borrowers find it very easy to buy and to get loans in normal times, right? What would your competitors do when you chopped your interest rate?
They'd follow suit.
They'd respond, right? And at the end of the day, do we make more money? We all make a lot less money, right? But there are, in any society, a significant portions of people who are not creditworthy, right? And they will agree to pay a higher interest rate, right? And that higher nominal rate, if you don't establish loss reserves, has to show up as a spread, a big positive spread. It's just mathematics and accounting at that point. Although I would emphasize something I haven't emphasized. The really pernicious part that gets added on is when a lot of this income is non-cash. So you have to understand the basics of accrual accounting. Is that a familiar thing, accrual versus cash accounting? Okay, so when you have, and Ireland has had these, non-amortizing, or at least non-fully amortizing loans, banks are booking as income things that they've never received in cash. That's how accrual accounting works. Well, you know, I can agree to do lots of things where I'm not actually paying in cash. So that's why people make bad loans. Bad loans pay why bankers make deliberately bad loans. They will create this phony income, whereas trying to make good loans would produce real losses.
And Professor, sorry, I mean, that's the point, trying to come to quickly, deliberately making bad loans.
Yes.
They make this with the knowledge that they're making bad loans.
Absolutely.
But what about people then, as we've seen in certain cases, where people are investing themselves in what their own bank is investing in, the banker is?
Right.
And they're losing money then in that scenario also.
So some of this occurs, but vastly less than people think. So let's talk about it. So one thing is compensation is often paid in shares, right? And so they say, look how much I lost when the bank failed because the share price fell. But the share price was never real. The only reason the share price reached those kind of numbers was precisely because of the strategies of the recipe. So they never lost money because it wasn't there. But also, even the bankers who are running these schemes, they don't know when the bubble is going to end. Nobody knows when the bubble is in. So sometimes people stay too long in the game. But frequently, even then, you'll find that it wasn't really their money. It was the bank's money in those circumstances. So I would be far less impressed with this line of logic that says, oh, they must not have been doing anything deliberately wrong because they too suffered some losses in these circumstances. That doesn't follow logically.
Okay, thank you. And then just going back to the prior step in terms of this extreme growth and the role that commercial property lending plays for a bank in managing to make that extreme growth, and what that relationship then is with the regulator as well in that context.
Well, again, extreme growth is itself something that you shouldn't allow as a regulator. We have, again, centuries of experience that tells us that that is true. And concentration of risk is something that for a large institution is insane. In other words, there are small players that can't reach economies of scale, and they have to have niche strategies. So they will concentrate, and that is riskier, but they have no great choices, right? All of their choices involve material risk. But for a very large financial institution, you don't want them concentrating their risk, say A, in a product line, like commercial lending, but then B, no, even if you're going to concentrate in commercial lending, you would never, ever, ever prudently concentrate in a small number of borrowers. That old joke is absolutely true that they tell about banking, right? That if you borrow $10,000 from the bank owns you. But if you borrow $100 million from the bank, you own the bank, right? They will extend even bigger loans to you, and as long as new money is coming in, you can keep the thing alive a bit, and that always is a bubble disaster. And again, we've known this from many past crises. This was something easy for the bankers, easy for the regulators to figure out. The Irish crisis was one of the most easily preventable crises by either competent bankers or competent regulators you can imagine.
Okay, thank you.
Thank you.